Unlocking the secret of Forex trading often begins with mastering the art of candlestick patterns. These visual representations of price are not just pretty pictures on your chart. They are a powerful tool that, when interpreted correctly, can offer profound insights into market sentiment and potential price movements. So today, we are diving deep into the world of candlestick patterns, exploring how to recognize and interpret these formations to predict market reversals, continuations, and breakouts, ultimately crafting a winning Forex strategy. Let's start by understanding the basics. Candlestick patterns. At their core, candlesticks show the battle between buyers and sellers within a specific time frame.
It's time to fight back!
The body of the candlestick represents the opening and closing prices, while the wick or shadows indicate the highest and lowest prices during that period. The color of the candlestick, even though so many people change this to their likings, green shows bullish for upward, and red for a bearish downtrend or the move to the downside. This gives you a quick snapshot of the market direction. The hammer pattern is one of the most recognizable and powerful reversal signals. It forms when a currency pair trades significantly lower than its opening but rallies to close near its opening price. This pattern, resembling a hammer with its small body and long lower wick, suggests that buyers have stepped in to support the price, potentially signaling the end of a downtrend and the beginning of an uptrend. The psychology behind this pattern is simple yet profound. Sellers pushed price down, but buyers regained control, pushed it back, indicating a strong buying interest. In contrast, shooting star pattern signals a potential reversal at the top of an uptrend. It has a small body near the lower end of the trading range and a long upper wick, indicating that buyers pushed the price higher, but sellers quickly took over, driving the price back down. This pattern tells you that the bullish momentum is weakening and a bearish reversal may be imminent. For instance, if you spot a shooting star after a strong upward move, it would be a signal to consider exiting your long position or even entering a short trade. Bullish engulfing and bearish engulfing patterns are also crucial in predicting reversals. A bullish engulfing pattern occurs when a small bearish candlestick is followed by a larger bullish candlestick that completely engulfs the previous one. This pattern indicates a strong shift in sentiment from sellers to buyers, often signaling the start of an uptrend. On the other hand, a bearish engulfing pattern forms when a small bullish candlestick is followed by a longer bearish candlestick, indicating a shift from buyers to sellers and potentially making the beginning of a downtrend. Moving on, the Doji pattern is another powerful signal that indicates market indecision. A doji forms when the opening and closing prices are nearly identical, resulting in a very small body with long wicks on either side. This pattern suggests that neither buyers nor sellers have gained control, and a reversal or continuation could be on the horizon. Depending on the preceding trade, for example, if you spot a doji after a prolonged uptrend, it could indicate that the bullish momentum is fading and a reversal may be approaching. Now, moving on. The piercing line pattern is a two candlestick pattern that signals a potential bullish reversal. It forms during a downtrend when a bearish candlestick is followed by a bullish candlestick that crosses above the midpoint of the previous candle's body. This pattern suggests that buyers are stepping in and the downtrend may be coming to an end. The psychology behind this pattern is that sellers push the price lower, but buyers have stepped in to gain strength, potentially leading to an uptrend. When you are reading candlesticks, just envision it. Imagine like when a real market, everyday market, each candle tells its own story, and no story is yet worthy to live unnoticed. So understanding the psychology behind this pattern is key to interpreting them correctly. Each pattern represents a story of the market participants, emotions, fear, greed, indecision that you can use to anticipate future price movements. By recognizing these patterns, you can better understand the underlying market sentiment and make more informed trading decisions. So, to maximize your trading success, it is essential to combine candlestick patterns with other technical indicators and analysis tools. For example, pairing candlestick patterns with support and resistance levels can enhance your ability to identify the key zones where reversals are more likely to occur. If a bullish engulfing pattern forms near a strong support level, it could be a powerful signal to enter a long trade. And similarly, if a bearish engulfing pattern forms near a resistance level, it could be a signal to go short. Now, let's delve into trend reversal patterns. The head and shoulder pattern is one of the most well-known and reliable reversal patterns. It consists of three peaks: a high peak, which is the head between two lower peaks, or the shoulders. This pattern typically forms at the top of an uptrend and signals that the trend may be reversing to the downside. The psychology behind this pattern is that buyers attempt to push the price higher, the head, but they met with increasing selling pressure, leading to a reversal. In that same direction, we have the inverse head and shoulder pattern, which is the bullish counterpart. And this one signals a potential reversal at the bottom of a downtrend. It has a similar structure to the head and shoulder pattern, but inverted, with three throws instead of peaks. This pattern indicates that the downtrend is losing momentum and a new uptrend may be starting. For example, if you spot an inverse head and shoulder pattern forming after a prolonged downtrend, it could be a signal to prepare for a potential bullish reversal. Now, moving on in that same direction, triple tops and triple bottoms. A triple top occurs when the price reaches the same resistance level 3 times without breaking through, indicating that the uptrend is weakening and the reversal may be imminent. And conversely, a triple bottom forms when the price hits the same support level 3 times without breaking below, signaling that the downtrend may be losing steam and a reversal could be on the horizon. When it comes to trend continuation, patterns like rising 3 methods or falling 3 methods are invaluable. These patterns consist of a series of smaller candles that move counter to the prevailing trend, followed by a larger candle that resumes the original trend. For example, in an uptrend, the rising 3 methods patterns show a temporary pullback, followed by a continuation of the upward move. This pattern reassures you that the trend is still intact and it might be a good time to enter the trade. The on neckline and thrust patterns are also useful for identifying trend continuations. The on neckline pattern forms when a bearish candle is followed by a smaller bullish candle that closes near the low of the previous candle, signaling that the downtrend is likely to continue. The thrust pattern, on the other hand, occurs when a bullish candle is followed by a smaller bearish candle that crosses near the high of the previous candle, indicating that the uptrend is likely to persist. These patterns can help you stay in a trade longer, capturing more profits as the trade continues. To develop a winning forex strategy with candlestick patterns, it is crucial to incorporate these patterns into a well-rounded trading plan. This plan should include clear criteria for entering and exiting trades based on candlestick patterns, as well as risk management techniques like setting stop losses to protect your capital. For example, if you are trading a bullish engulfing pattern, you might set your stop loss just below the low of the engulfing candle to minimize your risk. Then discipline is key when trading with candlestick patterns. It is important to wait for the pattern to fully form before making a trade, rather than jumping in prematurely. For instance, if you spot a potential hammer pattern, wait for the candle to close before entering the trade. This patience ensures that you are trading based on a confirmed signal rather than on speculation. To further enhance your strategy, consider using candlestick patterns in conjunctions with other analysis tools such as moving averages, Fibonacci retracement levels. For example, if a bullish engulfing pattern forms at the 61.8% Fibonacci retracement level, it could be a strong signal to enter a long trade, as this confluence of signals increase the likelihood of a successful trade. So, in my conclusion, mastering candlestick patterns is an essential skill for any forex trader. By understanding the psychology behind these patterns and incorporating them into a well-rounded trading plan, you can significantly improve your trading success. Remember to combine candlestick patterns with other technical indicators. Practice patience and discipline, and always manage your risk. With time and experience, you will develop the ability to recognize and interpret candlestick patterns with confidence, leading to more consistent and potential trades.
Oh, thanks for watching.
If you found this video helpful, please don't forget to like, share, and subscribe for more in-depth forex trading insights. Leave a comment below with your thoughts or questions, and let me know what topics you would like me to cover next. Remember, successful trading is about staying informed and showing up every day, of course. I'll be seeing you in another video. My name is Osi, the Bone Child, and bye-bye.